Hi, everybody, and welcome back to video number 8 in chapter 17. And when we left off, we were looking at putting into practice revenue issues. And we left off with number 2 here. On July 1, 2025, Outback sells 20 e-boosters to Nick's Liquor. Nick signs a note due in 6 months at an annual interest rate of 12%. Outback allows Nick's to return any e-boosters that it cannot use within 120 days and receive a full refund. Based on prior experience, Outback estimates that 3 units will be returned using the most likely outcome approach. Outback's cost to recover the products will be immaterial, and the return generators are expected to be resold at a profit. No e-boosters have been returned as of March 31, 2025, and Outback still estimates that 3 units will be returned in the future. Number 3, Outback sells 30 e-boosters to Community Bank in the Florida Keys to provide uninterrupted power for bank branches with ATMs for a total contract price of $50,000. In addition to the e-boosters, Outback also provides installation at a standalone selling price of $200 per e-booster. The cost to Outback to install is $150 per e-booster. The e-boosters are delivered and installed on March 1, 2025, and full payment is made to Outback. And lastly, number 4, Outback ships 300 e-boosters to Home Depot on consignment. By March 31, 2025, Home Depot has sold 3/4 of the consigned merchandise at the listed price of $1,500 per unit. Home Depot notifies Outback of the sales, retains an 8% commission, and remits the cash due to Outback. They wanted you to determine the net income for Outback Industries for the first quarter of 2025 and ignore taxes. So, for number 1, the sales revenue, let's go back, just briefly look at number 1 here. We have 450,000, 360,000 sales. Okay. And so the revenue is going to be 95% of that $1,500 per unit times 240 units, or $342,000. The cost of goods sold will be $340 times 240 units, or $177,600. So the gross income will be $164,400. And if I go back to number 1, you'll remember that they provided this 5% volume discount for the e-boosters. Okay, that one's pretty straightforward. Now for number 2, let's go back and look briefly at that. The interest, it was 6 months, 12%, and they could return any unused within 120 days. Okay, so here we're going to take 20 units times $1,500, or $30,000, less the estimated returns, which is 3 of them at $1,500, or $4,500. So the net sales are going to be $25,500. Cost of goods sold, the 17 units times $740, for a gross profit of $12,920. Interest revenue was the $30,000 times 12% times 3 months, or $900. So the net income on this arrangement was $13,820. And number three, the total transaction price of $50,000 is allocated between the equipment and installation. The transaction price for the equipment and installation is allocated based on the relative standalone selling price, which we've done several times. So we're going to take 45,000 plus 51,000 and multiply that times 50,000, and that's going to be $44,118. This should have been a dividing sign. And then we'll take the installation, which will be $6,000 divided by 51,000, multiplied by 50,000, or $5,882. Okay, you see that here. Cost of goods sold, 30 units times 740 for 22,200, and the installation expense was 30 units times $150 per unit for installation. And our net profit then is going to be the 21,918 minus the 5,882 minus the 4,500, which leaves us a net profit of $1,382. So the net income from these two transactions would be $23,300. And lastly, number four, we'll go back briefly and visit four. Here we had the consigned inventory and 300 of the little beauties and an 8% commission. So we take 225 units. Let's go back. 225 units, right? Because they sold 3/4 of the 300 units. So we will take 3/4 of $300, 225 units times $1,500, $337,500. Cost of goods sold at $740 per unit, or $166,500. So our gross profit, $171,000. Commission, 8% of that $171,000, or $27,000. And so the net income on this arrangement was $144,000. So in total, the net income on eBooster was $345,520. We get that by taking the six, and so Outback Industries' net income for the quarter is then going to be the $6 million, $6.5 million here. The expenses here, $43.50, $4,350,000, I should say, plus the $345,520, which gives us a grand total of $2,495,520. A long example, but I think you get the idea. All right, let's take a look at describing the presentation and disclosure for revenue. Contract assets are of two types. Number one, unconditional rights to receive consideration because the company has satisfied its performance obligation. And number two, conditional rights to receive consideration because the company has satisfied one performance obligation, but must satisfy another performance obligation before it can bill the customer. Okay, so here's an example. On January 1, 2025, Finn Company enters into a contract to transfer Product A and Product B to Obermein Company for $100,000. The contract specifies that payment of Product Alpha will not occur until Product Bravo is also delivered. In other words, payment will not occur until both products are transferred to Obermein. Fin determines that standalone selling price are $30,000 for product Alpha and $70,000 for product Bravo. Fin delivers product Alpha on February 1, 2025, and on March 1, 2025, Fin finally delivers product Bravo to Obermein. What journal entries should Fin make related to this contract? Well, no entry is required on January 1 because neither party has performed on the contract. On February 1, Fin is going to record that it's received a contract asset worth $30,000. Let's go back. Here's the $30,000. Okay, and that was delivered on February 1. So it's earned the revenue at this point in time. On February 1, Fin has satisfied its performance obligation and reports revenue of $30,000. But it does not record an accounts receivable at this point because it does not have an unconditional right to receive $100,000 unless it also transfers product Bravo to Obermein. In other words, the contract asset occurs generally when a company must satisfy another performance obligation before it is entitled to bill the customer. When Fin transfers product Bravo on March 1, 2025, it finally will make the following entry. It'll debit its accounts receivable for $100,000, credit the contract asset that it had debited on February 1 for $30,000, and record sales revenue of another $70,000. Okay. Contract liability is a company's obligation to transfer goods or services to a customer for which the company has received consideration from that customer. Okay, let's take a look at an example. On March 1, 2025, Henley Company enters into a contract to transfer a product to Propel Incorporated on July 31, 2025. It is agreed that Propel will pay the full price of $10,000 in advance on April 15, 2025. Henley delivers the product on July 31, 2025. The cost of the product is $7,500. So as we look at the journal entries for 2025, no entry is required on March 1, 2025, because neither party has performed on the contract. On receiving the cash on April 15, Henley's going to debit cash and credit unearned sales revenue, a liability, for $10,000. Then on the performance obligation on July 31, 2025, Henley's going to record the following entry. It will debit unearned sales revenue to zero out that liability and credit sales revenue for $10,000. And then in addition, it's going to this is the earned sales revenue here finally for $10,000. And at the same time, it will record the cost of goods sold as a debit and inventory as a credit for the cost of $7,500. So contract modifications. A change in contract terms while it is ongoing. And then companies determine whether a new contract and performance obligations result, or whether it is a modification of an existing contract. Okay, this looks like a good place for us to stop this video. And when we return, we'll look at contract modifications involving separate performance obligation. Until that time, bye for now.